Hi folks, Bang here. I just want to use Think or Swim platform to illustrate how to enter a long call option trade, right? Remember, when you enter a long call, mean you buy a call option, you have to be very bullish on the stock, meaning you expect the stock to move sharply in a relatively short period of time so that you can benefit from the upside, right? When you buy a long call, you have a limited max loss, meaning the premium you pay, that is your max loss. You cannot lose more than what you paid. On the other hand, if the stock price goes up, there's no limit on the upside. Okay, so unlimited upside potential. Having said that, because you pay premium, the time will work against you, meaning every day passes, you will lose a little money. So you need the stock price to move very strongly and in a short period of time so that it can offset with the time decay effect. Okay, if the stock doesn't move or even move in the wrong direction, which is going down, you lose money. Okay, but again, in any case, your max loss is your premium, right? When you enter a call option, you have to pick the stock with high momentum. So today I found one stock that I want to enter as a long call option, right? So GLD, as you know, GLD is the gold ETF. Okay, recently gold has reverted to a short-term uptrend, and essentially it has crossed above 200 moving average, and just few days ago the 50 moving average line has crossed the 200 moving average line as well. So at least give us some indication that hey, the stock momentum is strong and it could be reversing to a short-term uptrend, right? So with that in mind, I am thinking to enter a trade today. Before you to buy a call, again, one more criteria you need to check is check the volatility, implied volatility ranking or percentile. It need to be low. So if the ranking or percentile of IV is below 40, that could be a good time to buy. So how can you check it out, right? Just go to the trade tab here, type the GLD, you have it, right? And go down to the arrow here, today's options statistic. Just open it up. And you can find it right here, current IV percentile. It shows 13% today, meaning it's pretty low. So IV is low, so good time to buy. So this criteria is met now, right? Next one, when you buy a call option, you would prefer to buy a relatively long date to expiration or DTE so that you don't have the fast decay effect on your premium. So the rule of thumb is you need to choose the DTE of 2 months, which is 60 days or above, right? So I can find here a series of option with 65 days to expiration. So I open it up, which is on March 29, okay? And this could be the option that you want to buy in, right? So the stock price today right now at $121.22. So when you buy a call, my preference is to buy at the money or slightly in the money, okay? So that you can benefit in a meaningful way when the stock price move into your direction. So delta, the way you look at it is you refer to the column called delta. Delta need to be around 50 to 60, which means your option is at the money or slightly in the money, okay? So when the stock price is at 121, if I buy 121 here, I buy slightly in the money, right? Because the stock price is 121.24, I buy 21, mean the stock is in the money, okay? And the current delta is 56, 57, which is the right strike to buy, okay? Now if I buy this 121 strike call, I have to pay $2.26 per share, and you know one contract has 100 shares, so total premium I have to pay is $236. Okay. Now, another rule of thumb is you should not enter a trade which could potentially lose more than 2% of your total portfolio. Okay. So if you have a total portfolio size of like what, $10,000, right? So 2% of it will be $200. Okay, makes sense. So in this case, if you buy one contract, your max loss is $2.37 times $100 shares. That is 236 or 37 dollar, which is about 2% of your portfolio. So it also meet that criteria. So with that, normally if you want to have your order to be filled immediately, you need to click on the Ask column and pay at $2.37, and your order will be immediately filled, right? However, I am a little bit greedy, right? I always start with a slightly lower price and I wait for a few minutes, right? If it doesn't fill my order, I will gradually raise my price to somewhere in the middle and towards the ask price. So usually I would be able to get my order filled somewhere in the middle here between the bid and the ask. Okay, so with that, I also click on the ask, but I will reduce my premium to the bid level, right? So I click here, meaning the system tells me that I'm buying one call option, but I don't want to pay 236. I want to pay 232, right? It's likely that my order will not be filled, but I'm fine. I leave it there. Before I send it out, I want to check one more thing. What is my P&L profile or chart looks like, right? So right click on the panel here and analyze the trade. Here we go. It pop up the P&L chart under the analyze tab and risk profile. Okay, you see two lines here. The blue line, right, which is like Nike sign, right? This is the P&L line of my trade at the expiration date. Okay, so and in the left hand corner under here you see the box which have two numbers. One is the pink, one is the blue. Pink means the P&L as of end of today. Okay, and the blue line is the P&L at the expiration. As I move the mouse around, you see the number change, right? The number change. Okay, so you see that when you do a long call option, you don't have limit on the upside, right? The higher the stock price goes, the more profit you will get. But if the stock price stay exactly where it is or even goes down, right, your loss is capped. You see, $232. That is your max loss, and it can be more than that. Okay, that is your max loss. Okay, but if it's going up, you start making money. Okay, how do I know my break-even point? Well, your break-even point is your strike price plus the premium. Your strike price is 121 plus your premium at $2.32, right? So that is 123.2. That's your break-even point. Now, if you don't know exactly your math is correct or not, it's just simple. Go to this menu, set strike prices, and set at break-even, and choose the expiration date. Okay. Here we go. The system tells you here's your break-even point, 123.32. Okay, that's the exact break-even point. So today the price is 121, right? For you to break even, the stock price has to move up a little more than $2, which is your premium, by the way, for you to break even, right? Which is about 2%. So you just need to have your price to move up by roughly 2% to break even. If it goes beyond 2%, you start making money. Okay, so you have 65 days for the stock price to move up into your direction, because you are bullish, you are optimistic that your price will go up, and you have 65 days to prove that correct, right? If it doesn't, you start losing money. Okay, if it stay below your break-even point until the expiration date, you will lose money. But again, when you enter this trade, right, always limit your loss. You do not let the trade run until the expiration date. When you lose the max profit, the max premium, you have to cut loss the moment it already reached half of your max loss. So in this case, your max loss is 232. If you lose 110, $115, then you start to cut loss, right? So that's the rule of thumb. Or you let the trade goes halfway, meaning 30 days plus, and when there's still about 30 days left till expiration date, if your trade making money or losing money, you just need to close it. Reason for it is because the last 30 days of the trade, the time decay will be accelerated and it become very fast, and you lose money very fast, right? So avoid keeping your trade beyond 30 days or expiration date, right? If it cross that 30 days, better close it for a profit or a loss, okay? So whichever comes first, right? Either you hit your profit target, right? So for example, you pay $2.32. If you make another $232 as a profit, or double your money, you can exit it, or you simply cut loss if it dropped to $100, or if drop below 30 day to expiration date. So whatever comes first, just take action, and then you won't lose maximum premium for your trade, right? So if you're happy with that, go back to the trade tab here, check the market price again. Now it's still about 238, and perhaps you have to go to like $2.34 to have a chance for your order to be filled, right? So it showed that if I do this trade, right, my max loss is 234 now because I raised the premium, and my break-even point become 123.34. Okay, if I'm okay with that trade, I execute it. It go here and the monitor working order. You see here the market price asking for about $2.37, but I am willing to pay $2.34. Okay, so demand and supply has not met yet, so it will be fluctuating for some time. So I wait there for a few minutes. By the way, we are waiting for it. I just show you that GLD, okay, because I entered the order here, it prepared to get it filled, so it has some data here, but the quantity is 0 because the order has not been filled yet. The moment the order is filled, you see the quantity become 1, and you start seeing some profit or loss. Okay, so now look like the market is hovering around $2.38, 240 kind of thing. So look like I have to raise my price. Let's say I have to raise it to $2.36, see if I can get it filled, right? So the order has been changed. Look at here. So there's still 3-cent gap. Okay, so I wait for a little longer. And by the way, so today my portfolio P&L is this. I'm making some money here, but since I opened, the portfolio is losing a little money here, right? So with that, I'm so okay. Now it looks like the market is moving up again because the GLD price going higher. I raise one more price to $2.38 and see how it goes. Okay, so and look at this 121 strike. The bid price has now raised to $2.40. I will pay only $2.38. So unlikely I will get filled unless the price drop, right? See, the price has improved a little bit better versus the time I enter. So look like I had to raise one more time to $2.40, and I think this time it can be filled. No, it's still at around bid price, so let's wait for some time. Okay, so with that, once it's filled here, I will monitor the trade over the next few weeks. Again, this is 60 days, 65 days to expiration. So I monitor in the next 35 days or so. And by the time I hit 30 days, if my trade is making money, I close it. If it's losing money, I also close it. If it hit my profit target, which is double the money before that point in time, I also close it. If I lose half of my money, which is $110, $115, I also close it. Okay, so look like I need to raise one more price to get it filled. So let's raise it to 243. Okay, because market is going up. Okay, the price is improving, the call options premium also increasing, right? So we have to chase the market a little bit here, because in this case I really keen to get it filled so that I can go to bed. But in other situation where I'm not so keen, I just leave it there and I just go to bed. If it get filled, it doesn't, that's fine. So tomorrow I do it again. Okay, so the last raise, if it cannot be filled, I leave it there. Okay, so I raise it to 245. Okay, so go back to the chart. So it looked a little bit bullish, and again, when do you expect the price to be double? Your break-even point is 123 point something. For you to get double, the stock price need to go to about 125-ish or 126, right? Which is about $2 something above your break-even point, so that you will double your premium. Again, go back to this analyze chart. If your stock, see it's get filled right now, so if your stock price goes up, right, before the expiration date, and you sell, you could make more money, because between the pink line and the blue line there's still some time value remaining. So if you sell before expiration date, chances are you make more money than waiting until the expiration date. Okay, so let's go back to the monitor tab here. The order has been filled at $2.45, and right now the P&L day is 0 because we just enter. Now making a little money here. It will be fluctuating around break-even point for today, and then over the next few days and weeks, you see the P&L. Depends on which way the stock price move. Hi, today I would like to follow up on one trade we enter, right? Recall that was on 24th of January, and today is January 31st, so about a week ago we enter a trade using the long call option, and we bought a GLD, which is the gold ETF, and we bought it at the price of $2.45. Okay, now if you go to the chart, about a week ago, gold price, or the gold GLD ETF was at about 121, and I say that because now it already broke through on the key resistance level, so there's a good chance that the stock has a high momentum and it will continue to go up further, right? So we bought a call and we say we will exit either it double the money, so we bought $2.45. If it double the money, we exit. Or if it hit some target, for example, somebody who can look at the chart and they say 128 would be a very strong resistance level, so when it hit 128, we exit also, because there's a good chance it will not go through and then will drop back, right? Or when the time is running out and the DTE, or day to expiration, is less than 30 days, we just need to close it either with a profit or a loss. Or in the worst case, if we are wrong, completely wrong, the stock does not run up but it go back down and then reverse to the downtrend, and in that case we also need to exit with a loss. So what happened since then? Actually the stock has gone up, right? and we are making good money right here. So look at the profit of the trade right now. Okay, so now the mark, which is the market price of the option, is $4.92. Okay, remember when we bought it is $2.45, so it is actually double. So it hit one of our criteria, and then we just exit, right? In this case, it's a good thing. We double the money in a matter of a week, which is 100% return. It's not bad at all. So I'm going to show you on how to exit a trade, right? So if you want to really know how the market is beating on this call option, right? So go to the position, which is GLD. So type GLD, right? And the one that we are having a position now is the one that expiring on March 29, right? You see the system is telling you that you have a position here. Go to the strike that we bought, which is 121. You see the position there. And now if you exit the position right now, probably I can get it for 90, right? So 490 could be the price that I get filled, and with that I would double my money, right? So if I'm okay with that, then I just click to sell, or I can go back here and right click onto the trade and closing order, right? And choose to sell. Now of course it fill you at the lower price, which is the bid price, but you say I like to get a better price, so I raise it to 490. I have a good chance to get it filled, so let's see how it goes, right? So click and send. Okay, so your orders now is waiting to be filled right here, and the market is still fluctuating between 485 and 490, so there's a good chance it will be filled in the next few minutes or so. So let's see how it goes. But if you don't want to wait, right, you can reduce your credit or your price a little bit, then you can get it filled easier, right? So reduce it to 485, and see it's now filled. So basically what happened is after you exit the position, right, you go here, you see zero quantity because you completely sold the position, right? You bought at $2.45 and now you sold it at $4.85, so essentially double the money, and you make good profit there. So that's just demonstrate how to exit a position in the long call strategy. It's very simple, just one leg, and you pay either the mid price or the market price. All right, let's summarize the trade. It's a long call, simple option on GLD, right? So we enter the trade on 23rd of January, and we close it just a little more than a week after that on 31st January. Okay, so total days in the trade is 8 days. When we entered with one contract and at the price of $2.45 for one contract. That means $245, and that is also the capital or buying power. And then when I close it, I close for $4.85 per share, which means I collected $485 for one contract. And that translates into a profit of 485 minus 245, which is $240 before commissions. And if I do the return on investment calculation, that translates into about 98% return on investment. Is almost double the money in a matter of 8 days. It's a very good trade, very profitable in a very short period of time. So hopefully that gives you some idea of when you are bullish on one stock, you can use a call option to play around it, right? And then if you are right, you can make very good return on investment. If you lose some of the premium from the call option. My target zone where you lose maximum 50% of your premium. That's it. Happy trading.